December 2024 is shaping up to be a pivotal month in the Forex market. Traders are buzzing with anticipation. Why all the excitement? Several key factors are converging to create a volatile and potentially lucrative trading environment. Central banks around the world are hinting at policy shifts. The US dollar is showing signs of weakness. Global economic growth is slowing, and the US presidential election is adding another layer of uncertainty. In this essay, we'll explore these trends in detail and discuss their implications for Forex traders. We'll examine the potential impact on major currency pairs like EUR, USD, USD-JPY, and AUD-USD. Whether you're a seasoned trader or just starting out, understanding these trends is crucial for success in the Forex market. Get ready to navigate the December Forex fiesta. After months of aggressive interest rate hikes, central banks around the world are signaling a potential shift towards easing. This shift marks a significant change in the global economic landscape, as policymakers respond to evolving economic conditions and pressures. The question on everyone's mind is, who will be the first to cut rates, and what will be the implications for the global economy? The European Central Bank, or ECB, is expected to cut its key interest rate by 0.25 percentage points on December 12. This anticipated move comes as the Eurozone grapples with sluggish economic growth and persistent inflationary pressures. ECB President Christine Lagarde has hinted at the possibility of rate cuts in recent speeches, emphasizing the need to support economic activity and ensure price stability. This move, widely anticipated by market analysts, could weaken the euro against the US dollar. A weaker euro could boost exports by making European goods cheaper for foreign buyers, but it could also increase the cost of imports, potentially exacerbating inflation. Traders and investors are closely monitoring the euro's performance, as any significant fluctuations could have ripple effects across global markets. The Federal Reserve, the central bank of the United States, is also under pressure to cut rates. With the U.S. economy showing signs of slowing and inflation cooling from its peak, there is growing speculation that the Fed may soon pivot towards a more accommodative monetary policy. Fed Chair Jerome Powell has acknowledged the challenges facing the U.S. economy, including trade tensions and global uncertainties which could influence the Fed's decision-making process. The U.S. economy is showing signs of slowing, and inflation has cooled from its peak. Recent economic data indicates that consumer spending, a key driver of economic growth, has softened, while business investment remains subdued. These factors, combined with a cooling labor market, suggest that the Fed may need to take action to support economic growth and prevent a potential recession. A rate cut by the Fed could further weaken the USD. A weaker dollar could make U.S. exports more competitive on the global stage, but it could also lead to higher import prices, affecting consumers and businesses alike. The interplay between interest rates and currency values is complex, and traders must navigate these dynamics to make informed decisions. The Bank of England and the Bank of Japan are also facing crucial decisions. Both central banks are contending with unique economic challenges, from Brexit-related uncertainties in the UK to prolonged deflationary pressures in Japan. Their policy choices will not only impact their respective economies but also influence global financial markets. Their actions will have a significant impact on the British pound and the Japanese yen, respectively. A rate cut by the Bank of England could lead to a depreciation of the pound, affecting trade and investment flows. Similarly, any move by the Bank of Japan could influence the yen's value, with implications for Japan's export-driven economy. Traders are closely watching for any hints from these central banks about their future policy intentions. Central bank communications, including speeches, press conferences, and meeting minutes, are scrutinized for clues about the direction of monetary policy. These signals can trigger significant market reactions, as traders adjust their positions based on anticipated policy changes. The central bank tango is one of the biggest drivers of Forex market movements. As central banks navigate the delicate balance between supporting economic growth and controlling inflation, their decisions reverberate through the global financial system. Understanding these dynamics is crucial for anyone involved in the Forex market, from individual traders to large institutional investors. Understanding their policy decisions is essential for traders looking to capitalize on currency fluctuations. By staying informed about central bank actions and economic indicators, traders can better anticipate market movements and develop strategies to manage risk and maximize returns. In this ever-changing landscape, knowledge and adaptability are key to success in the Forex market. The US dollar, often seen as a safe haven currency, has been showing signs of weakness in recent weeks. Several factors are contributing to this trend. Cooling inflation in the US has led to a decline in US bond yields, making dollar-denominated assets less attractive to foreign investors. The Federal Reserve's potential shift towards rate cuts is also weighing on the greenback. Historically, December has been a bearish month for the US dollar. Year-end tax-driven flows from US corporations to overseas accounts often lead to a seasonal decline in the USD. Traders are closely watching USD pairs like EUR-USD and AUD-USD for potential trading opportunities. If the dollar continues to weaken, these pairs could see significant upward movement. Section 4. Global economy grinds Forex feels the pinch. How sluggish economies are reshaping Forex markets. In this segment, we delve into the intricate dynamics of the global economy and its profound impact on the Forex market. As economies around the world experience a slowdown, the ripple effects are being felt across currency trading floors and financial markets. Global economic growth is slowing, and this is having a ripple effect on the Forex market. The interconnected nature of today's global economy means that a slowdown in one region can have far-reaching consequences. Investors and traders are closely monitoring these developments, as they can significantly influence currency values and trading strategies. The OECD forecasts global growth to ease to 2.7% in 2024, the lowest annual rate since the global financial crisis, excluding the first year of the pandemic. This forecast has raised concerns among economists and market participants, as it suggests a prolonged period of economic stagnation. The implications for the Forex market are substantial, as slower growth can lead to reduced demand for certain currencies and increased volatility. The Eurozone is facing recessionary pressures, with Germany, its largest economy, particularly hard hit. Germany's industrial sector, a key driver of its economic growth, has been struggling with declining orders and production cuts. This has led to a weakening of the euro, as investors seek safer assets. The broader Eurozone is also grappling with high inflation and energy costs, further exacerbating the economic challenges. China, the world's second-largest economy, is also grappling with a slowdown. The Chinese government's efforts to stimulate growth through infrastructure spending and monetary easing have had limited success. The country's export-driven economy is facing headwinds from weaker global demand and trade tensions. As a result, the Chinese yuan has experienced increased volatility, impacting global currency markets. Its post-pandemic recovery has lost momentum, and its property market is in turmoil. The real estate sector, which has been a significant contributor to China's economic growth, is now facing a crisis. Property developers are struggling with debt, and construction projects are being delayed or abandoned. This has led to a loss of confidence among investors and a depreciation of the yuan. These global economic headwinds are impacting currency markets. The Forex market, known for its sensitivity to economic data and geopolitical events, is experiencing heightened volatility. Traders are navigating a complex landscape where traditional safe haven currencies like the US dollar and the Japanese yen are in high demand. Meanwhile, currencies of countries with weaker economic prospects are under pressure. The euro has weakened against the dollar, while commodity-linked currencies like the Australian dollar have been volatile, reflecting China's importance as a consumer of raw materials. The Australian dollar, often seen as a proxy for global risk sentiment, has been particularly sensitive to news about China's economic health. Fluctuations in commodity prices, driven by changes in demand from China, have added to the currency's volatility. Traders are adjusting their strategies to account for the slowing global economy. In this uncertain environment, Forex traders are employing a range of tactics to manage risk and capitalize on opportunities. Some are turning to technical analysis to identify short-term trading signals, while others are focusing on fundamental analysis to understand the broader economic trends. The goal is to navigate the market's ups and downs while protecting their investments. Some are seeking opportunities in safe haven currencies like the Swiss franc and the Japanese yen. These currencies are traditionally viewed as safe havens during times of economic uncertainty due to their stability and liquidity. The Swiss franc, in particular, has been a popular choice for investors looking to hedge against global risks. Similarly, the Japanese yen has seen increased demand as traders seek refuge from market volatility. Others are focusing on emerging markets that are showing more resilience. Despite the global slowdown, some emerging economies are managing to maintain growth, driven by strong domestic demand and favorable demographics. Currencies from these regions, such as the Indian rupee and the Brazilian real, are attracting interest from traders looking for higher returns. However, investing in emerging markets also comes with its own set of risks, including political instability and currency fluctuations. Section 5: U.S. Elections and Forex. Political drama meets Forex markets. The 2024 U.S. presidential election is adding another layer of complexity to the Forex market. As the candidates ramp up their campaigns, every statement, policy proposal, and debate performance is being scrutinized, not just by voters, but by traders and investors around the world. The stakes are incredibly high, and the financial markets are reacting to every twist and turn in the political narrative. The outcome of the election could have significant implications for U.S. fiscal policy, trade relations, and the overall direction of the U.S. economy. A win for one candidate might mean increased government spending and a focus on domestic issues, while a win for the other could signal a shift towards more conservative fiscal policies and a different approach to international trade. These potential changes are causing traders to constantly reassess their positions and strategies. Uncertainty surrounding the election is already creating volatility in the Forex market. Traders are finding it challenging to predict market movements as new polls and political developments emerge daily. This uncertainty is reflected in the fluctuating currency values, with the US dollar experiencing significant swings against other major currencies. The market's reaction to political news can be swift and dramatic, making it a challenging environment for even the most experienced traders. Traders are closely monitoring the polls and the political landscape for any clues about the potential winner and their likely policies. They are analyzing every piece of information from campaign speeches to social media posts to gauge the possible direction of the election. This intense scrutiny is not just limited to the candidates' economic policies, but extends to their stances on foreign relations, healthcare, and other critical issues that could impact the market. The US dollar, being the world's reserve currency, is particularly sensitive to political developments in the United States. Any indication of a shift in policy or a change in administration can lead to immediate reactions in the Forex market. Traders are acutely aware of this and are positioning themselves to either capitalize on or hedge against potential movements in the dollar's value. The dollar's performance is not just a reflection of domestic economic health, but also of global confidence in the U.S. political system. A change in administration or a shift in policy direction could trigger significant moves in USD pairs. For instance, a candidate who is perceived as business-friendly might boost investor confidence, leading to a stronger dollar. Conversely, a candidate who advocates for higher taxes or increased regulation might cause the dollar to weaken. These potential outcomes are being factored into trading strategies, with traders trying to anticipate the market's reaction to different election scenarios. Traders are bracing for potential volatility in the run-up to the election and its aftermath. The period leading up to the election is expected to be particularly turbulent, with market participants reacting to every new piece of information. The aftermath of the election could also see significant market movements, especially if the results are contested or if there is a significant policy shift. Traders are preparing for all possible outcomes, knowing that the stakes are incredibly high. Understanding the political landscape and its potential impact on the Forex market is crucial for navigating this period of uncertainty. Traders need to stay informed and be ready to adapt their strategies as new information becomes available. This election is not just a political event, it is a major market-moving event that requires careful analysis and strategic planning. By staying vigilant and responsive, traders can better manage the risks and opportunities that come with this high-stakes political drama.